Welcome to the Valuation Desk by Highland Global, where SBA business valuations speak bank. I'm thrilled to be here to discuss a topic that's critical for SBA lending, the difference between EBITDA and free cash flow. Bankers often see EBITDA, earnings before interest, taxes, depreciation, and amortization, in selling memorandums, letters of intent, and valuation reports. It's quick, clean, and popular. But let's be clear, EBITDA is not free cash flow. In lending, that distinction isn't just technical, it's make or break. EBITDA shows profitability, but it doesn't tell us what cash is actually available after servicing debt or capital expenditures. Free cash flow does. Free cash flow accounts for real-world cash drains like taxes, changes in working capital, and capital expenditures, the things that determine whether a borrower can repay an SBA loan. As important, the fair market value is generally driven by free cash flow, not EBITDA. Consider two companies both with $500,000 in EBITDA. One needs $100,000 yearly for new equipment and inventory. The other only needs $20,000 yearly for CapEx. EBITDA makes them look identical, but free cash flow reveals the first has only $250,000 left, while the second has $375. That's a huge difference for debt repayment, and it makes a huge difference in the valuation. Aswath Damodaran, a valuation expert, warns that EBITDA ignores CapEx and working capital, the lifeblood of small businesses. His point hits home for SBA lending, where cash flow is king. Stephen Kaplan and Richard Rubak's study in the Journal of Finance found that actual cash flows, not earnings, drive a business's true value. Their work confirms what experience teaches us. Applying a multiple to EBITDA, common with business brokers and underwriters, can wildly overstate a business's worth, especially if it has high CapEx or tight margins. It's a shortcut that hides risks like insufficient cash for loan payments. Jim Hitchner, in his valuation textbook, critiques EBITDA multiples for small businesses. Public company multiples don't fit closely held firms with unique risks, leading to distorted valuations. Most appraisers prefer the capitalization of earnings method for SBA business acquisition loan valuations, using free cash flow to convert sustainable cash flows into a realistic value. This method ensures a fair market value that reflects what a business can actually support. So, what does all of this mean for bankers? When a valuation leans on EBITDA, dig deeper. Ask, what's the free cash flow? After taxes, working capital, and CapEx, what's left to repay the loan? That number, not EBITDA, keeps the loan safe. Ask appraisers for the free cash flow behind their numbers. It's what ensures your SBA loan is repaid. Thanks for joining us for this episode of the Valuation Desk. Behind every financial model and final value is a professional who knows how to interpret the story behind the numbers. At Highland Global, our depth of experience ensures that your appraisal isn't just technically sound, it's contextually accurate, SBA compliant, and thoughtfully reasoned. We've prepared thousands of business valuations and machinery appraisals, and we understand the details that make or break a deal. Because in lending, it's not just about the math, it's about the judgment behind it. For more information on valuation-related topics, be sure to visit our website highlandglobal.com. Lenders know experience matters most.